Rhynhardt, what is your view as to how the uncertainty over Fed policy action, how the uncertainty over the ECB decisions with regards to its bond buying and I suppose pulling a rabbit out the hat, those type of factors, how's that playing into the local market activity?
Look, I think that those issues are certainly major issues, and I think that there's a lot of expectation that something will happen later this week. We know that the Fed is meeting tomorrow, so again, it's a fairly big day. We've seen markets rally relatively strongly from intra-month lows the last, say, couple of trading sessions or so. So I would say that if we don't see any policy action, any stimulus, I think markets are probably going to be in for quite a big sell-off, to be honest, to be fairly honest. And a lot of expectation, I think, at this point is certainly baked into markets. Which way it will go, I'm not entirely sure, but my bias is a little bit to the downside. I think stimulus will be fairly underwhelming. I think that the market will always look for more. So I think it's going to be a fairly tough trading week.
It's very tough to actually tell what's going to happen on a day-to-day basis, and that has been the name of the game for some time now. Where do you hide? Which sector, which stock would you say is most defensive in this environment?
Sure, quite difficult to say. You know, if I just look at our market, there's obviously been a major disparity in say the performance of the resources sector and of the financial and industrial sector. So it makes it quite difficult to hide in the Findy at this stage. And resources, unfortunately, if you're uncertain about the global macroeconomic outlook, it doesn't tend to do well. Well, I would hide though is probably in gold. I think that even if they don't do major stimulus now, I think expectation of stimulus further down the line would be fairly positive for the gold price. So I would probably hide in gold.
That's an interesting view. So let's look at those gold stocks. Any interest in them?
Yes, certainly. You know, I think that most of the major gold companies have certainly derated quite significantly. You know, PE multiples for the likes of Gold Fields and Anglo Gold is probably in like the region of say 10 times. Yes, they are facing major cost increases, and they do need the Rand gold price to continue to go up in order to kind of show any kind of earnings growth, but it certainly doesn't look expensive. They've significantly underperformed the Rand gold price. And as I said, I think expectations of further stimulus down the line will probably keep, I think, the gold price relatively steady. And then again, we must bear in mind that we've got low interest rates globally, and that is also fairly supportive for the gold price.
Let's look at the stock, a smaller stock, I suppose, in the resources space, somewhat more industrial manufacturing space as well. Merafe production being hit there by the fact that it's been forced to cut back on production as a result of its high electricity consumption. What are your thoughts on the numbers that we saw, that trading update for the full year from Merafe?
Look, I think it was fairly much in line with our expectations, but then again, our expectations have never been very optimistic. You know, that is, I suppose, if you look at Merafe, it is clearly one of the companies or one of the smaller juniors that is certainly struggling. I think that global demand for ferrochrome has been relatively weak, and then as a producer in South Africa, it's even more difficult because, as you've pointed out, you are dealing with rapidly increasing energy prices, and it's not going to get any easier in the second half of the year because we're entering winter tariffs. What they have done, they have tried to scale back on their, say, production, but still it's a very tough operating environment. They desperately need a weaker Rand in order to generate significantly higher, higher earnings. Yes, the share has done very badly, but I do struggle to kind of see them making fairly good returns on capital over the medium term, given their cost structure.
Now, one of the other stocks that has done pretty well, given its defensive nature, is Cipla Medpro, but a disappointing trading update for the first half coming out today, looking at earnings slipping back almost 40%, 38%, where we saw, of course, that strong full year earnings were up by 80%. So how did, what is your view on this news today? Because the market didn't react well to it.
Look, I think you must look at the normalized number, and if I recall correctly, I think normalized earnings, stripping out any kind of funnies, I think was actually up. I think it was up well north of maybe like 20%. Yes, you are right in pointing out that maybe the market wanted more, and I think probably what the market doesn't like is that it'll probably get slightly more difficult for them, I think, like over the next 6 to 12 months or so, because they tend to like import all of their drugs, and the average rand where it is now is certainly weaker than where it was in the comparative period, which means that their cost base will probably like tend to go up, which means margins will come under a bit of pressure. So I don't think one can extrapolate the current earnings into the future. It's going to be a more difficult second half. Yes, the share is relatively cheap on a PE multiple basis. I think it's trading at roughly about 11 times expected forward earnings, which is certainly at a discount to the peer group, and their project pipeline is certainly reasonable, but we tend to prefer the other players in that specific sector.
Okay, and then lastly, Rhynhardt, just as we close out the trading day today, an update that the Botswanan government choosing not to increase its stake in De Beers. So that means Anglo American now will have an 85% shareholding in De Beers. And of course, this is one of its problem children, problem issues for the company. We've seen De Beers earnings falling back for the first half of the year. They were hit 53% down. How does this affect your view of Anglo, if at all?
Look, I think it's quite difficult to call. Yes, you are right in pointing out that it has maybe been one of the problem children. If you listen to Anglo, they would tell you that it's a great longer-term asset because global demand for diamonds is only going to increase going forward. I think in the short term, it's probably certainly a negative. I think if you look at the balance sheet of Anglo American, it's probably still relatively healthy, but relative to the peer group, whereas maybe a year ago they had the strongest balance sheet, net debt right now is probably well north of $10 billion. And I think the market probably would have hoped that the government would take up their like option, which meant that which would have meant that Anglo American would have had to pay less. So in the short term, I certainly think it is a negative. They are effectively increasing now exposure to an asset where earnings are under some like pressure and prices are certainly not heading north at the moment. So perhaps slightly negative in the short term, I would say.
Rhynhardt, thank you so much for joining us today. As always, Rhynhardt Roodt, equity analyst at Investec Asset Management.